All right, let's begin. Hey everyone, thank you for joining us. I'm Syed from Consumer Reports, and I'm excited for our panel today. As a follow-up to our credit checkup survey, an innovative project to encourage people to check their credit reports and report back the types of errors they find, we put together an impactful lineup of experts to talk about what consumers should know about credit reports. Checking your credit report is critical. At least 1 in 4 of us probably has an error on a report, and the COVID-19 financial crisis has made that bad situation even worse. Complaints about mistakes have grown dramatically over the past year, and consumer financial health can hinge on the accuracy of your credit report. We're excited to bring together experts to share what they know about credit reporting. Before we begin, just a few things to note. First, you can join in the conversation by using the chat function. You can ask questions and show your support there. And also, we're recording today's session so we can share the panel with folks that weren't able to join us today. Joining me today are Michael DeLong from the Consumer Federation of America. Michael joined CFA in April 2020 as the Research and Advocacy Associate for CFA's campaign for fair auto insurance. In this role, he conducts research on auto insurance and advocates for better, fair, and more affordable practices that will protect consumers. Michael also served as a legislative assistant for 2 Maryland state delegates. Along with Michael, we have got Ed Mierzwinski from the U.S. Public Interest Research Group. Ed Mierzwinski is a senior director for federal consumer programs at U.S. PIRG, the Federation of Nonprofit State Public Interest Research Groups. He's been working on credit reporting reform since 1989. Thank you both for being with us today. With that out of the way, I'll dive straight up into our first question. What are credit scores used for? And what exactly are they? The answer to that question, stranger than we think. I'll start with Ed first.
Well, thank you, Syed, and I appreciate being here today. The real issue here is the accuracy of credit reports. A credit report is essentially like a resume, like your resume of your financial history. It records information about how you pay your bills, whether you pay them on time or whether you pay them late. And then it also includes public record information. Have you ever sued anyone? Has anyone ever sued you? Have you ever filed for bankruptcy, et cetera, et cetera? Public record information is always negative. It never is included if it's positive, but your credit report trade lines on how you pay your bills. If you pay your bills on time, it's essentially like you had an A. If you pay your bills 30 days late, it's essentially like you had a B on that bill, and all the way down to if you never paid it, you get an F. But the credit score, so the credit report is like your resume, and the credit score is derived from your credit report. It's essentially like if you were still in college, it's essentially like a grade point average. It's one number that summarizes your credit report. So your credit report is sold by the gatekeepers to your financial and employment future, the big 3 credit bureaus. There are many other credit bureaus that are more specialized, but the big 3 are in the essentially the credit reporting business, and they report to lenders either a credit report or a credit score derived from that report. So again, your credit score is a summary of your credit report. It's like your cumulative grade point average versus your resume.
Awesome. Yeah. Michael, can you expand on that a bit more?
Of course. Thank you, Ed. And basically, credit scores, these are the numbers that they use to theoretically assess the risk of lending you money. Basically, they give you the score by the major credit agencies, and an excellent credit score is anything above 800 or higher. A good credit score, what they consider is between 670 and 739. Fair credit score between 580 and 669, and one between 300 and 579 is considered poor. And they're used for an immense amount of things, actually. They can be used to determine if you get approved for a financial product, whether it's an auto loan or a credit card, whether it's a mortgage. Indirectly, they can affect where you live, what interest rates you have to pay if you're approved for these loans. And where I work, mostly on auto insurance, they are used to determine how high your auto insurance premium is. They are also tend to have quite a lot of errors, and they tend to be quite discriminatory against people who are low income or African Americans. And indirectly, they can contribute to systemic racism and unfair discrimination. This makes it all the more important to know what they are, if there are errors on your credit reports, how to check them, and how to contest them. And CFA has also been trying to get the use of credit not used, to ban the use of credit in auto insurance because of its being unfairly discriminatory. So.
Thank you for that. Before I move on to the next question, I kind of want to expand on this just a little bit. Why might a consumer see some differences in their scores between the three bureaus? And why might a consumer might see that their lender has a different score than the one that they think they have? Can either of you answer that?
Yeah, I'll start and then Michael can follow up. But basically, there is no one credit score. The Cadillac of credit scores for many years is known as the FICO score. It developed by the Fair Isaac Corporation, and they contract with the credit bureaus and they create credit scores for lenders and for the credit bureaus themselves. The credit bureaus also have a shared company where they generate their own set of credit scores. And so whether you're using Vantage Score owned by the credit bureaus themselves, or whether you're using FICO score, your lender could have either an Experian score, an Equifax score, or a TransUnion score, or most likely, most lenders ask for a customized score. They tweak it just a little bit. And so most lenders, for decision-making purposes, use a version of the FICO score, whether it's customized or not. Many scores that you can get online from various websites are known as educational scores, and those are the scores that companies give out for free for marketing purposes, and they might be, in many ways, a little bit different. The second thing that makes your score different than the score that your lender might use is what it's calculated on the basis of, because your credit report, the data in your credit report is changing all the time, and it's not changing. The three credit bureaus are not changing their data all at the same time. They might be getting data from a lender on March 15th. The other credit bureau might be getting that data from the lender and uploading it on March 1st. So there are a lot of different variables out there that make scores go up and down and change slightly. But I can tell you they're all pretty close. Like if you have a 700 on some version of a FICO score that you can see on some open website that gives it away for free to basically attract traffic to their site. If you have a 700 on one score and a 580 on another score, that's where I would be concerned. But if you have a 700 versus a 710, I wouldn't be concerned.
Yeah, the credit scores may vary slightly between the three companies. They also may vary slightly because some lenders may use a specialized scores depending on like the type of loan that they're considering you for. If it might be slightly customized for the type of product. For instance, an auto lender might be looking for a credit score or calculate it that is supposed to better predict whether you will be payback an auto loan, and a mortgage lender might do something similar.
Got it. Thank you for that. Let's move on to the next question and take it a step back to the source material, which is the report. This seems to be a very, very critical document in the life of the consumer. I mean, it controls so many different parts of their financial life. And it seems to be held by three major institutions: Experian, TransUnion, and Equifax. Why aren't these reports made free for consumers throughout the year? And can you guys just touch on that a bit more? It seems odd that this is consumers' own data, but they have to pay to access it.
You know, until the big Equifax breach 3 years ago, where Equifax lost the information of some 148 million Americans, that is, it exposed the information of some 148 million Americans to hackers who rooted around inside Equifax's servers for a long time. people on Capitol Hill, Congress, that we would try to lobby to strengthen the credit reporting laws, they didn't really understand it, but now they all do. And they understand that we are not the customers of the credit bureaus. We are their product. They sell our information. Their customers are businesses. So the fact is that we're starting to get a realization out there that the credit reporting industry serves the businesses that buy the reports and also provide the information that populates the reports. But consumers, we're just their product. And so these credit reports then are designed to benefit businesses' purposes, and consumer advocates believe that the credit reporting system perpetuates the racial wealth gap, as Michael discussed earlier. And we also believe that they tend to lean in their credit reporting model, they tend to lean toward including information that may not be about you, but maybe about somebody with a similar name than you, just in case. They want to be sure that they have all the information. They don't want to miss any information. So consequently, we believe that the filter that they use to put information in a credit report leans toward putting extra information that isn't exactly about the right person.
Agreed. And also, I'd like to piggybacking off of that, I'd like to point out that since we consumers are not like, say, the people that the credit reporting agencies are appealing to, that means they have no incentive to try and quickly fix errors. For instance, if there was like an ordinary business that sold, for instance, a product and consumers give bad feedback, then the business usually has at least some incentive to try and improve the product or the price or whatever consumers find objectionable. But since this information is being collected, our information is being collected and sold to businesses, that's what the credit reporting agencies are really only concerned about. So.
Got it. Thank you both for your answer. At this moment, I want to let the audience know that we're going to be dropping a question in the chat, basically like an audience poll. And the question is, have you checked your credit report in the last year? Please fill out the poll and drop your answer in the chat and let us know. And while y'all are doing that, I'll move on to our next question. So we know that the credit bureaus themselves kind of house this grade card that we all have. Nice. People have been checking the credit report. We all know that the credit bureaus house this financial grade card that we all have, and they charge us to access it. And we know that lenders and banks and many other institutions rely on this information to make decisions. So very broad question here. Who actually has your credit report, and how many different types of institutions have your credit report? Who actually has their eyes on your credit information? And either of you can take it away.
Well, I would say that, the big three credit bureaus operate nationwide. They have over 200 million credit reports containing billions of pieces of information, and they'll sell them to any company that has a permissible purpose to use a credit report, which generally under the law is for use of credit, for use of insurance review, or for use of employment review. There are a couple of other catch-all provisions, but those are the big three reasons that companies can legally buy credit reports. So all those characterizations of companies, creditors, insurance companies, employers, tenant screening companies sell a specialized kind of a report to landlords. There are medical insurance companies that sell a specialized kind of report. There are also two or so specialized credit bureaus that report on, quote, bounce check activity, unquote. And those credit reports, the specialized reports, are used to determine who is eligible to open a bank account. One question that you asked earlier, Syed, that I apologize, I skipped over. Why aren't credit reports free? I basically answered that we're not their customers, but we believe there should be more transparency in the credit reporting marketplace. And for 30 years, again, I've worked alongside Consumer Reports and other consumer organizations. The CFA particularly has done some work that, again, all the way back 30 years we've been working on this. Why did we start working on it 30 years ago? Well, that's when I came to Washington. That's also when there'd been a wave of consolidation. The original credit reporting law, the Fair Credit Reporting Act, had been passed in 1970 when there were more than 3 credit bureaus, but they were localized, regionalized. They basically started merging over the years, and the mergers resulted in a lot of garbage in, garbage out. They were using different computer programs. They made a lot of mistakes. And around 1990, Congress and many state attorneys general were looking at the credit bureaus and putting them under enforcement orders. The idea of getting a free credit report had always been allowed under the law, but the credit bureaus didn't tell you you had the right to a free credit report. And so the first change that occurred was that the requirement that they notice you that after you've been denied credit, you have the right to a free credit report. So after that, throughout the 90s, we fought to get the right to a free credit report, and won by law. And so there is a right to a free credit report. And under the COVID emergency that we've been living under for just about a year now, the industry has voluntarily said that they're providing credit reports as often as you need them, essentially, for free during the extent of the emergency. But in the 1990s, we also then fought for the right to get a free credit score. And starting in California, with the campaign led by Consumer Reports, and the realtors were very interested in working with consumer groups at the time. We started fighting for credit scores to be included in free credit reports. We still haven't ultimately achieved that, but we're getting closer to it. Credit scores and credit reports should be free. Companies should not be allowed to sell our information into commerce without our consent, which they do without our consent, but at least they shouldn't be allowed to sell our information without us being able to audit it for free. We should have the right to look at the same credit score that a lender looks at when the lender is deciding whether to give us credit. And we should have the right, again, to look at credit reports and scores integrated into those reports for free all the time.
100% agree. And following up, some banks and lenders obviously can get your credit report, insurers as well. In some cases, actually student loan providers, because in some cases, your credit history could be considered for student loans. Landlords can also run get your credit, and some actually refuse to rent to people if their credit is below like a certain level. And that actually also impacts you by making it so in many cases, they can't live in certain areas or certain neighborhoods. And in some states, current or potential employers can get a modified version of your credit report, although they do have to get your written consent. So, and also going back to the companies, and there used to be more credit reporting companies, but then there was the wave of mergers, and this big corporate consolidation has led to there basically being the big 3. And that's not good for consumers, because if you have more competition, that obviously results in better products and prices. And it's a safeguard against corporate abuse to a certain extent, because if one company is treating you very badly, then you can go and do business and get working with another company. But if you have 3 firms that form like an oligopoly, it's relatively easy for them to say, we're all going to do our bad practices, and there's not much that can stop them aside from state or federal regulators.
So let's touch on that a bit. So we've talked a lot about the big 3, Experian, Equifax, and TransUnion. And we've mentioned how there only really being 3 major credit bureaus can be a problem for consumers. How reliable are these companies in their work, and how accountable and responsive are they when consumers speak up, when they have a dispute? Can you guys touch on that a bit?
Well, I could talk about this one till the cows come home. And basically, the credit bureaus don't keep their reports accurate, and then they ignore disputes from consumers. They often farm the disputes out to affiliates in other countries. Many other countries people are looking at your credit report. And they're on the time clock, by the way. These supposed dispute investigators are required to investigate 6 disputes an hour, or even 10 or more disputes an hour. And they're required to finish them up. And, basically they're on a piecework system. And so the disputes don't get fixed. Syed, you mentioned that 1 in 4 of us could have an error in our credit reports. Well, the FTC study that is still a definitive study, even though it was finished in 2012 and released in 2013, that definitive study showed that 1 in 20 of us, basically 5% of everybody, has such a significant mistake on his or her credit report that they would be denied credit, pay more for credit than they should pay, or be denied employment. So it's a very significant problem. And the data that has been out there that Consumer Reports has released, PIRG has released, other groups, the CFA is looking at as well, from the consumer complaint database of the Consumer Financial Protection Bureau, shows that during the pandemic year of 2020, consumer complaints about every kind of financial product went up to a new record in 2020. But what was the top line of that record? The credit bureaus were the number 1, 2, and 3 complained about company in the financial marketplace, and more than half of all complaints to the CFPB in 2020 were about credit reporting mistakes. Hello, if that doesn't tell you that there's a problem, then I don't know what you're looking at. But the previous CFPB ignored that problem and actually told the credit bureaus, oh, don't worry if you can't comply with the law and investigate disputes quickly enough. That's why we're excited about the new leadership of the Consumer Financial Protection Bureau. The acting director has already said he is going to hold the credit bureaus accountable. We need to do better to protect people's credit, because people's credit is their good name. And if you don't have a good name and somebody else is responsible for it, that's really not fair, is it?
It's definitely not. And 3 big credit bureaus, they're not very accountable to consumers. They're not very responsive. They're not helpful. In 2012, the Consumer Financial Protection Bureau, they actually adopted a rule to begin supervising them and writing rules governing them. In recent years, as Ed mentioned, more and more lawmakers and policymakers have been realizing what a big problem this is. But the Trump administration was, to put it mildly, not very interested in meaningful oversight or meaningful reform. But we're hopeful that that's going to change under the new administration. Rohit Chopra, who is actually a former CFA staffer, recognizes the need for in holding the credit bureaus accountable and ensuring that people aren't discriminated against. He's actually been nominated to lead the Consumer Financial Protection Bureau. So we're hopeful that there will be like a wave of reform.
Absolutely. So let's touch a bit more about why credit reports are inaccurate. It seems it would seem that it would be mission critical for the bureaus to make sure that they get it right 100% of the time. Why are credit reports inaccurate so often? Ed, you mentioned that FTC study, which is still the gold standard for this type of information about credit reporting. Why do inaccuracies happen? Is it that there's just too much data? Do the bureaus just do sloppy work? Is it that their interests don't lie in actually making the reports accurate? Can you two explore that for me a bit?
Well, I think your last point is one that I tried to make earlier, and I'll restate it again because I think it's so important. We are not their customer. We are their product. They try to please their business customers, and their business customers might want a longer report that is about all the people named Ed Mierzwinski, not just this Ed M. Mierzwinski Jr., et cetera, et cetera. And if people have more common names, I'm using my name partly as a joke, but there are other people not related to me, not even, that I don't even know, who are, are in credit bureau databases, and they mix us up. It's happened to me many times. So if your name is Smith or Jones, you've got a real problem. And if it's David Jones or John Smith, again, very common names, you've got a real problem. If your father or your son is a junior or a third, those problems exist as well. But they make mistakes. One of the examples that the magisterial National Consumer Law Center, who is another ally of ours, has pointed out on many occasions is that the credit bureaus don't accurately match consumers with the identifier that is commonly used in their database. And what's that? Of course, the social security number. You might think, well, you've got to have all 9 digits of the social security number to make sure that this person is not that person. Guess what? The credit bureaus commonly match on 7 out of the 9, not all 9 of the digits in your social. That's one problem. There are many other problems. Over the years, the credit bureaus have done some astonishing things. Back in the 1990s, one of the credit bureaus went up to Vermont. They hired actually an outside consultant, basically like hiring a real estate agent, but hired an agent, but it didn't matter. It was still them. They hired an agent to go up to Vermont and collect information about who had paid their taxes and who had not paid their taxes. And they went to one town, actually Norwich, Vermont, and they collected the list of everybody who had paid their taxes, not the list of everybody who had not paid their taxes, and they inserted it into credit reports. That caused now Senator Bernie Sanders, but Congressman Bernie Sanders at the time, to become a fierce advocate and supporter of reform of the credit reporting industry, obviously, because many people from Norwich, Vermont were calling his office. They were also calling the Attorney General's office, and Vermont became one of the leading states to pass a number of reforms that then ultimately led to some of the reforms that we passed here in Congress. But the point is that their incentives are not the right incentives. I'm sorry, the big three. An oligopoly has a different set of incentives. It's not a monopoly, so it's not like the old AT&Ts. Those of you who are old enough to remember, AT&T used to say, yes, you can have any phone you want as long as it's black. And dial phone sits on your desk, and they refuse to allow any companies to innovate with any new ideas, even colored phones, even a little hood that went over your phone if you worked in an office so that you could hear better. They blocked everything until they were put under a lot of pressure. These 3 credit bureaus have not been feeling enough pain, even from the CFPB. I love the CFPB. Along with your organizations, we helped to create the CFPB. But even back in the 1990s, the investigations by the FTC and any number of attorneys general, there were no significant penalties imposed on the credit bureaus. Very few times the credit bureaus have been fined. They have given basically what I call go-away money. We'll give you state officials and federal agencies, we'll give you go-away money, but we won't change our business model. And that's really been the problem. They've not been held, their feet have not been held to the fire, and their wallets have not felt the pain of paying a penalty for doing a sloppy job.
They don't, you agreed, they do not have the proper incentives. Something that Consumer Federation of America has found is that one of the most common errors on credit reports is like, because they want to include everything and sometimes get people confused, but they also will sometimes count a bad debt or something twice over. Because, and so for instance, if someone had like a bad time where they like missed a payment on, say, like a mortgage or a student loan or something, it may be double counted. And among other things, I wanted to emphasize this. When someone misses a payment, it's not always a accurate reflection of like their total life circumstances or whether they will fail to pay back in the future. someone could, for instance, have gone through a period of unemployment. In fact, huge numbers of people became unemployed through no fault of their own due to the pandemic. And then they have likely struggled to pay utilities, mortgages, loans, many other things, again, through no fault of their own. And their credit reports will probably take a hit from that. And it has no bearing on, for instance, whether they will be able to pay back loans or be willing to pay back loans in the future. And these three big companies need to be held accountable. Oftentimes, as you said, Ed, they haven't really been held accountable. They haven't been fined. We've noticed that in other cases, if there's a big, incredibly powerful corporation making a lot of money from a bad practice, if they receive like a token fine from regulators, they just brush it off as the cost of doing business. Like, we had to pay like a $5 million fine for this, but it's immensely profitable. It's making us like 200 million a year. So we're just going to write that off as like a business expense and keep on going. So the fines and penalties need to be strong and meaningful enough to stop this.
Hey, could I follow up on that, Syed? Michael made a very good point about information on credit reports, and another life circumstance that has created a lot of the information on credit reports that's wrong is medical debt. First of all, some medical debt is because of slow pay insurance companies. Quite a bit of medical debt is due to slow pay insurance companies messing up, and then the doctor or the hospital or the practice sells that debt when they only try to collect it for 6 months or so. The consumer presumes, oh, I thought that the insurance company was going to pay for that, but then they sell it to a downstream debt buyer, kind of a debt collector who buys other debts from companies, is called a debt buyer, but then they try to collect it. And if they don't collect it, they use the threat for a while, and as long as they're within the statute of limitations, of threatening to sue you. We're going to sue you if you don't pay this debt. But hey, if you pay part of it, we might take it off your credit report. That's kind of the way they nudge people. They park bad debt on your credit report, particularly medical debt. Medical debt is awfully dangerous because, again, once you have a debt collector posting information on your credit report, it's more negative than a lender, because the debt collector doesn't post that you're a good person. They only post that you didn't pay. A bank will give you an A if you pay your bills on time. It will give you a B if you pay your bills pretty close to on time. Again, you can get a C or a D on your credit report on the trade line from your bank, but the trade line from these medical debt collectors, which is often wrong, is mostly just an F, big fat F. And sometimes the medical debts are tiny copays, $30 or $100. And we're trying to get all medical debt off credit reports, as are both your organizations as well, because medical debt in particular is due to a life event. It's not due to a propensity to be a deadbeat, as the bank lobbyists often like to tell me. We need this information on your credit report because you might be a deadbeat. Well, heck, if you get sick or you get laid off or you get some other kind of a life event, like somebody dies or somebody gets divorced, those all lead to financial problems that may not be your fault, and they are filling up your credit report with unfair negative information that these companies exploit.
So let's talk about that a little more. It very much seems like just your rent and your cell phone payment aren't the only things that are going on your credit report. Your credit report seems to have a lot of information about you. Can you all touch a bit more about the exact things that actually end up on credit reports, some of the more stranger things that consumers wouldn't think about, and how long that stuff actually stays on the report? Because if a credit bureau makes a mistake here, it can haunt a consumer for a very long time.
Michael, you want to start?
Sure. What goes on a credit report? Your payment history for various bills, your debt burden, how long your credit history is, the types of credit you have, and even recent credit searches. And from what I understand, most negative information stays on your credit report for about 7 years, except for bankruptcy, which lasts for 10 years. And we do not think either of those things should be there for that long. There have even been some cases, in fact, actually, I think this is quite frequent, where people have bad credit because they never had the opportunity to get credit in the first place, whether they were low income or they and haven't had any experience with like getting a credit card or paying a mortgage or anything else along those lines. So.
That's absolutely correct. And so the thing about some of the information you mentioned, Syed, not all landlords report to credit bureaus. They might only report information about a consumer who they claim was, didn't pay their rent or whatever, but sometimes some perhaps not so good landlords might report you if you file a complaint with the housing authority about your house or your apartment being uninhabitable. You have the right to make those kinds of complaints, but some of the tenant screening companies are some of the worst offenders for treating consumers badly. So a lot of information about your life gets onto your credit report only occasionally. The companies that are most commonly on your credit report are the big national lenders, the credit card companies, the banks, the mortgage companies, and the student loan companies, of course. But the fact is that some information at the local level, if you have a mortgage with a small bank and that bank doesn't sell your mortgage to a big servicing company, and there aren't that many banks that do this anymore, keep a loan on the books. But there might be a small bank that doesn't report your mortgage. But there's a lot of different information. And I think the other kinds of information that gets on your report was the subject of a recent attorneys general, 31 or 33 state attorneys general in 2015 sued the credit bureaus over negative public record information. What is a public record? Again, a public record like up in Norwich, Vermont 30 years ago is a record filed in a courthouse or a town assessor's office. And most public records are only you've been sued, you've filed for bankruptcy, you've had a lien on your car or your house. They're not good to have, public records, but they don't get them from lenders. Lenders have big files of information and it's pretty accurate most of the time. Lenders know how much money you borrowed from them, how much money is on your credit card, how much money you have in the bank. But a town clerk's office, that's not their main job to collect all this information and share it. So often the information that gets on your credit report from a town assessor or a judge's office is information that doesn't say it's about Ed Merzwinski, his full name, his full social security number, and his full address. They might copy lists that look more like a telephone book. Telephone book doesn't have your social security number in it. They might buy a list from a data broker and insert it on your credit report. And so the public records that get onto your credit report were the source, were the primary reason for a big settlement order by 33 states that essentially improved a lot of credit reports by striking a lot of this information when they didn't have the full name and address and other information to document that the person who had a negative public record is you. They had to remove it from your credit report.
Got it. Thank you so much. I'm going to go into our next poll, our next audience poll. The question is, if you've checked your credit report and have found errors, do you know how to dispute them? And feel free to respond to that in the chat or in the poll. And I'm actually going to give people a few moments this time to fill that out. And then after this, we're going to go straight into audience questions.
May I just actually say one more point I want to make?
Sure.
With regard to credit history and credit scores, they're also discriminatory against people who are low income. there's been a whole bunch of studies, as we mentioned, that as income goes down, your credit score tends to go down. And this also contributes to racial inequality as well, because African Americans and Latinos tend to have significantly lower incomes. And so you have this thing where even if there wasn't any like overt discrimination on the basis of race, just on the basis of income, it's having a huge disparate impact on African Americans and Latinos, and so contributes to systemic racism. And it's sort of like a loop where these people have difficulty getting access to credit, and as a result, they have low credit scores, and that makes it still makes it even more difficult for them to get access to credit or loans or anything. And so it's like a self-perpetuating cycle. And there needs to be like regulation or initiatives to try and break this, because frankly, the big credit reporting agencies are not interested at all in doing it because it's not profitable for them.
If I could add one point, I would encourage, if there are any reporters in particular on this webinar, that they might be also contacting the credit bureaus for comment. And the credit bureaus might say, we don't know what the problem is. Credit scores have actually increased during the pandemic, so we think everybody's in good shape. That's not correct. And I'd encourage those reporters to also check a new National Consumer Law Center, nclc.org, issue brief on why credit scores have gone up. They might have gone up on average, but remember that we're facing a K-shaped recovery in this pandemic. So the average of people with good credit scores, the average is being helped by people with good credit scores, but there are a lot of lower income people, people of color, communities of color, where they don't have the benefits that a lot of people do, able to work from home, that sort of thing, and they don't have as much money, and their credit scores have gone down. So on average, credit scores may have gone up a little, but for half of America, they've gone down.
The Nevada Division of Insurance realized this and put in place a regulation, which CFA testified in support of, saying you can't use credit information during the pandemic and for 2 years afterwards to increase people's insurance premiums. So
there we go. Let's move on to our first audience question. This one comes from Pamela. The question is, so how do I get an accurate credit score? Either of you can jump at that one.
Well, I would just say that there are many credit scores out there. If you're saying, how can I improve my credit score and make it more accurate, scrutinize your credit report, make sure that your credit report is only about you and doesn't include a bunch of information about somebody with a similar name. And the problem is that then you've got to contact the credit bureaus and urge them to fix your report. I recommend to people that you have the right to contact the credit bureau, and you also have the right to contact the company that furnished the information. That is commonly either a creditor, a lender, or it can also unfortunately be a debt collector who puts the information on your credit report. If you find information on your credit report that's wrong, you can initiate an investigation either way. And what do you do to push or kind of really put some energy behind those investigations? File a complaint with the Consumer Financial Protection Bureau, cfpb.gov. The Consumer Financial Protection Bureau is there to help you. It has only one job: protect consumers. It is swamped with reports about complaints about the big three credit bureaus, but they're going to try to fix that under the new administration. As Michael mentioned, Rohit Chopra has been nominated by President Biden to run the agency, and we think there will be improvement, but you need to help yourself as much as possible. If you have a problem on your credit report that you can't seem to get fixed and you're in the market for credit, I would advise you, it doesn't work all the time, but I would advise you to consider trying to explain that to your potential lender and show them documentation that you have a problem with your credit report, and the credit bureau won't fix it.
Thanks for that, Ed. Michael, I've got a question for you. This one from Lisa. Why do negative items stay for 7 years on a person's report? Michael, I think you mentioned bankruptcies stay on there even longer. That seems pretty unfair and a little too long. Um, can you help us understand why?
It is very unfair. I actually am still learning quite a bit about this, but I would say it's probably because the credit reporting agencies want basically an excuse to discriminate, and they don't really care. Say, for instance, leaving something on the report for 7 years hurts a consumer's life. They think even if, say, for instance, it would only be like a meaningful measure for 3 years, because after then the person has recovered, and they think they're like, I don't really care. I just want more information. And there's also quite a bit of it. With bankruptcy, it's a little more complicated because that has at least a little bit of bearing on whether you will be able to pay back your loans. But still, we think 10 years is far too long. And again, even with bankruptcy, there are many cases of when someone, for instance, goes bankrupt because of maybe a decision, or maybe unpaid expenses that suddenly came up, or medical debt. The United States healthcare system and people getting overcharged at hospitals and doctors, and then having to resort to GoFundMe to pay their bills. That's now become like a staple. And in that case, bankruptcy, frankly, shouldn't. And there's not even any provision on your credit report for like, this person went bankrupt because they had an illness or had to pay for a family member's illness, and had incurred a lot of medical debt. So, and also I wanted to just follow up about the Consumer Financial Protection Bureau, and I can actually put this in the chat if you want. They have a section where they can not only provide instructions on how to submit a dispute with the credit reporting agencies, but also a template for like, so you can follow it and say, this is my complaint, et cetera, et cetera. So, which.
If I could add briefly, Syed, to the answer, since the 1970 Act was passed, credit bureaus have been allowed by law to keep that information for 7 years. So at that time, I speculate they must have argued that it had bearing. Legislation that passed the House of Representatives last year, and we expect to be reintroduced in this new Congress, actually shortened the length of time that information can stay on credit reports, depending on the information, to 3 or 4 years, I believe.
Do you know what the breakdown on like, was it like overwhelmingly passed? Was there like a partisan split, or?
Well, it was passed primarily on a partisan basis, as all legislation in the last Congress that I can think of that was substantive was passed. And that this year, we obviously are working to get more bipartisan legislation passed. That's the only way things are going to pass the Senate. But it's something that has to be done. But the point is, the credit bureaus need to be cleaned up. The House has developed a blueprint over the last several years with several bills that they've passed. And one of the key changes is to require credit bureaus to use all 9 digits of your credit report, your social security number in your credit report. Another change is shorten the length of time that information can stay on a credit report to 3 or 4 years.
Thanks for that. Ed, I've got a question for you. How have the credit bureaus increased their security since the Equifax breach? And is my personal data safe? This question comes from our friend Fred.
Well, I think the answer to that is that you've got to verify, trust but verify, as a former president once said. You've got to trust but verify by looking at your own credit report and keeping track of your information. The credit bureaus have claimed they're spending, in particular, Equifax has claimed it's spending billions of dollars. Well, they should have been spending that money even beforehand. And is your information required to be safe and secure? Yes, it is. But do we know that it's safe and secure? That depends on the CFPB doing some of the investigations and supervision and examination to determine not only is the information in your report accurate, but is your report protected safely. And unfortunately, I can say it's probably better than it was before the Equifax debacle. But is it safe enough? I don't think so.
Mm-hmm. Definitely.
Michael, feel free to jump at that one too, if you'd like.
I think Ed summarized it very well. I'm admittedly skeptical of their claims that they've solved the data breaches or at least put in place stronger security. I think that the lack of transparency among the credit reporting agencies is a pretty clear sign that they're doing some things. They are doing a lot of things actually they do not want us to know about. And sunlight is the best disinfectant, and the whole market actually needs to be made significantly more transparent. It also needs to be, in my opinion, made more competitive. I think the market would be much better served if you had more, instead of an oligopoly of three massive corporations, more companies that were actually competing. Too often it seems like they collude to just engage in the best practices and then shrug off any criticism or fines.
If I could add briefly, Syed, the most protected data and the most restricted data about consumers that is for sale or sharing on the internet is essentially the Fair Credit Reporting Act data, the data in your credit report. Your credit report, for better or worse, is the most protected information on the internet. But the credit bureaus themselves also have direct marketing divisions where they sell information. They can sell much of the information that is in their databases, provided that it is not used for marketing purposes, but they can sell a lot of information in other ways. And then there are other companies that are not credit bureaus that share and sell information that's very similar to what the credit bureaus sell. So it's not just these three companies that have similar information. Your banks have similar information. Your grocery stores have similar information. A big grocery store was hacked this week. We have heard about a lot of hacks being posed by state actors, other countries that want our information for various purposes, to disrupt our voting system, to disrupt our economy. In addition to the state actors, there are a lot of criminal enterprises out there trying to collect your information. So it isn't just your credit report that needs better security, it's all your information. And one of the solutions going forward is to change the way companies just collect information about us 24/7, 365. We need to limit the amount of information that they collect. We need to limit the amount of the time that they keep the information for. We just need a wholesale reinvention of our data economy.
Got it. This will be our final question, and it comes from Edward and Carmen. What are some of the things that your organizations have done to pressure credit bureaus to not discriminate against African Americans, Latinos, communities of colors, and other marginalized groups? And what are some of the things that we can do right now in our advocacy to pressure them to not discriminate? I absolutely agree with both of you that this system is ripe with cycles that keep people marginalized and keeps things locked in that K shape. So Ed or Michael, can we touch on that a bit?
Sure. Consumer Federation, we've sent numerous letters to the credit reporting agencies and to many other groups as well, including auto insurers, saying this is how your practices can discriminate against African Americans and Latinos and other people of color, perpetuate systemic racism. Here are reforms you should take. Most of the time, they've tried to brush us off. So we've responded by supporting legislation at both the state and federal level. There are a couple of bills, I do not remember their numbers off the top of my head, but that would limit or end the use of credit information in various areas, including auto insurance. And we've supported numerous bills at the state level that there's actually a hearing in Oregon later today and a hearing in Maryland tomorrow about bills that would ban the use of credit information in pricing auto insurance, and that would help reduce systemic discrimination. Public pressure, transparency, again, they want things to remain secret and for people to be poorly informed, and they don't want people to know what they're up to. Meeting with legislators, contacting your legislators matters quite a bit, including sometimes your state legislators. They're significantly more accessible and reachable than your members of Congress. a lot of people do not know whom actually their state representatives or senators are, but you can usually talk to them or their staffers relatively easily. And you can also submit to them, say, this is a complaint we've been having with this credit reporting agency. What are you planning to do? What are your reforms? What are your ideas to do to stop this? And those are just a few ideas off the top of my head.
I want to add one that I think I'm teeing up a question for one of your panelists in the next 2 days. Am I right that we are going to have Amy Traub on one of these webinars? Or
Amy, I don't think we have booked her. We do have a panel coming up on the intersection of credit reporting and race. And that
okay.
on Friday.
I'll just give a shout out. I'll just give a shout out to some of the work that she has done. But the group Demos, and this was included, her idea was included in President Biden's platform, is to fire the credit bureaus. Let's just get rid of the credit bureaus and let's have an agency that is set up for only one job, protecting consumers. The CFPB run a public credit registry. It would have better incentives. And I'm working with Demos, DEMOS.org, and Consumer Reports and CFA. We're all working on reforming the credit bureaus in a lot of different ways. We've been supporting the legislation on the Hill. In particular, we've been trying to get rid of some of the worst ideas that have been out there. So since 1970, it's been legal to look at credit reports for employment purposes. It's been legal to raise your car insurance rates because you paid your MasterCard late, not on the basis of how you drive. That's just crazy. It's crazy to deny somebody a job because of a mistake on their credit report or because their credit report is not perfect, even if it is accurate. And it's the same thing with auto insurance. And so all our organizations have been working in the states on this. We pledge to keep working in Congress on this, and we pledge to clean up the credit bureaus. But I think maybe one idea that Congress will look closely at is firing the credit bureaus.
That would be fantastic. That would actually be utterly a fantastic idea. Publicly available information for everyone, and that's not subject to all these horrible incentives and horrible behavior. So.
Wonderful ideas. Before we wrap up, I just want to remind folks that Consumer Reports is still in the midst of our credit checkup survey project. This is a project where we ask folks to check their credit report through annualcreditreport.com. That's where you can check your credit reports once per week for free. Check your credit report, we'll walk you through it, and then report back to us some of the details you find about how accurate your experience was. You can also learn more about credit reports in some of the resources we'll be sending your way. And a reminder to keep in touch with us at facebook.com/CRA advocacy. You can see us on Twitter and tag us at our handle there. Ed, Michael, thank you both so much for coming here. This was a wonderful hour. We've educated thousands of consumers on this issue and will continue to do so in our work at both CFA and at USPIRG. Thanks again, everyone.
Thank you. Thank you very much.